In today's economy, more people than ever are looking to buy and sell businesses. But how do you do it? Welcome to the Deal Board, presented by Transworld Business Advisors. Straight talk about real deals and real people. Listen to stories, interviews, and expert advice to help your business sale, merger, or acquisition process. Now, here are your business exit experts, Andy and Jessica.
Now that we've explained valuation and what a business is truly worth, we figured we'd go to our network and ask some brokers and experts in the industry how much they think a business is worth. So tell me, how much do you think a business is worth as a multiple of sellers' discretionary earnings?
Hey, Tom, welcome to the program. I just want to ask you, how much does a business sell for?
Well, that's funny, Andy. The magic number is 2 times.
Hey, it's Eric Strauss from New York. A business is worth 2 times SDE.
Al Fiakovich, Managing Director, Denver, Colorado. 2 times, baby.
Chris Cantwell, 2 times.
Chris Werfel, 2 times.
Gary Goldwasser, 2 times.
Greg Kunz, 2 times.
This is John Woodhall, 2 times.
Matt Prescott, 2 times earnings.
Roger Smolik, 2 times.
Hey, we're back with Eric Woodworth from Chevy Chase, Maryland, the DC metro area. And Eric, what's the current multiple on small business?
Well, Andy, let me think about it a little bit. I think it's 2 times.
Hey, we have John Roman from Atlanta, and we're going to ask him the same question we've been asking a lot of people. John, what is the current multiple for small businesses?
Andy, the current multiple have always been and always will be 2 times.
Transworld Business Advisors is the world's largest business brokerage and mergers and acquisitions firm with over 500 brokers in nearly 200 offices worldwide. Transworld's team handles thousands of business sales every year. To be connected with a qualified business broker or learn more about the buying and selling process, visit tworld.com/the deal board or call 888-719-9098.
So we seem to have a consensus there that businesses are worth 2 times. But, that's a very simplistic way of looking at what businesses are worth. And before we jump into, 2 times SDE, let's talk real quick. I just want to put aside larger businesses. So if we're going to talk about larger businesses that are earning $1 million or more, probably grossing $5 to $10 million, those businesses, when they're sold to other businesses, they usually calculate EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. So those businesses, we're just going to put those in a different category. Those are selling for 4 or 5 time multiple. Let's get back to small businesses that have earnings of let's say just, businesses from 0 to $1 million. And those businesses we're going to calculate SDE. And what is SDE? SDE is seller's discretionary earnings. And that is EBITDA, all the earnings, before taxes, depreciation, amortization, plus an owner's salary, plus the perks that go along. And we're going to we're going to have we're going to have a whole podcast based just on how you calculate SDE, and we'll talk more about that. So, back to this is small businesses 2 times, but we see variations in that, right, Jessica?
Yeah, definitely. I think there's a range, and it's based on, we're going to talk about quality and quantity of earnings. And, ultimately we look at the market and see what other businesses in similar industries are selling for, look for some comparable data.
Right. So, and that goes to valuation. So, real valuation, quote unquote, where, people have degrees in valuation, which I have my certificate of business appraisal. And you really used 3 approaches and methodologies to, within those 3 approaches to find what a business is valued. The first one is, of course, the asset method, which you just add up what the assets are worth, including intangibles. And that's what the business is worth. The cash, the inventory, the equipment, perhaps goodwill. But that doesn't really work for most businesses that are making money. So the asset method is kind of usually thrown out. Then the next way people look at things is a multiple of earnings or some sort of, discounted cash flow or cap rate method for small businesses. And these methodologies can be very, very complicated, and the cap buildup method and all these things. And I liken it to operating on a gnat with human tools. As soon as you put the scalpel on a little gnat, it kind of squishes them. So the income method, while, we're going to talk about why income is so important in businesses. And really, that's kind of like the bottom line. But the income method for using these highly complicated valuation approaches and methodologies, that kind of goes away in the simple mans of, people buying businesses and selling businesses. So the last way, which is really a really great way that, brokers have access to, and there's a bunch of databases, the comparable method or the market method. So why don't you talk a little bit about that?
Yeah, I mean, the market method ultimately, what we're looking at is we're looking at a database of businesses that have sold that are similar to the business we're valuing. So we can, look based on industry, based on size, based on geography, based on when it sold. And ultimately, what the market method is telling us is what a buyer is willing to pay for the business. And I think that's probably the most solid method to use for valuation when we're talking about businesses of this size, of looking at real-time data. And you see in other assets when they're valuing it, like real estate, they're using similar methods too. They're looking at the marketplace and seeing what the marketplace is willing to pay for something, and that's ultimately what the market method is.
Yeah. And so when we look at the market method and the comparable method, all these databases have the ability to compare two things. They compare the gross revenues, which is a really nice way to compare businesses, because the gross revenues, quote unquote, you can't change them too much. You can't play with them too much. So they're very consistent. And so you can compare gross revenues of, say, restaurants, and restaurants sell for, say, 25 to 33%. And you could pull restaurants of that size in that neighborhood of that kind of restaurants, and we could really drill down to comparing revenues. Now, the good news about comparing revenues is it's more consistent. The bad news is if a business is not making money, I don't care what the revenues are, it's not going to sell, right?
Yeah, I mean, ultimately, I think, like you said, revenue is like, a good metric to look at for pulling simple data. But when you come to valuation, people run businesses very differently, right? So you can be in the same industry in the exact same business, and one company could be doing $2 million in revenue and losing $200,000, and another company could be doing $2 million in revenue and making $200,000. So I think that's ultimately why we look at earnings for the true valuation.
Right. And so once we get to the earnings, we look at the earnings, and we do a recast, which we'll talk more about. But we're trying to get everybody on the same plane, and recasting the earnings and looking at the specific earnings of those businesses, because obviously when people do their tax returns, they're trying to minimize the income to make it look, so they don't have to pay taxes. And then, we're trying to show businesses in the best possible light, or at least all, the real light of what their earnings are worth. And those earnings, say if a business makes $100 to $200 to $300,000, yes, it's going to sell for approximately 2 times that. And, you could pull all the data, and there's thousands upon thousands of businesses. And if you pulled all the data and you did the price to earnings ratios, your price to seller's discretionary earnings, it would literally be a 2. And, we see restaurants sell for a little less than that. We see other businesses sell for a little more than that. But I always like to say that, quality and quantity of earnings are going to drive multiples. So I think the easy one first is quantity, right?
Yeah, I think the more money a business makes, ultimately, the less risky it is, right? So, if somebody has a business that's making $75,000 a year, it's a little riskier to buy, because if they make $100,000 mistake that first year in the business, it's going to put them out of the business. But, if the earnings are $750,000 and the mistake is $100,000 mistake, yeah, it's still pretty expensive, but they're still in business year 2. So the quantity of earnings definitely reduces the risk in the acquisition.
Right. And that's why, private equity and all those, quote unquote, really smart people in the world like to buy businesses that make at least 2 million bucks because, at 2 million bucks, they can make a lot of mistakes and they can put management in place and they can make changes. And there's still a lot of quote unquote room for error. So when you're buying a small business, the quantity of the earnings absolutely drive the multiple. So if a business, like you said, makes less than $50,000, it's a very risky business. It might sell for 1x. And then, as you see, right, businesses that make 2 to 300 or even 4 or 500, pushing 3, maybe even 4 sometimes.
Yeah, sometimes, I think, that's where you get into the quality too. You get businesses that are making more money and you can push a 3x multiple or 4x multiple, but ultimately that will be driven by the quality of the earnings and the quality of the business operations as well. Hey, Andy, you know what time I think it is? I think it's time to talk about our deal of the week.
Deal of the week. Hey, welcome back. And we have a great deal of the week we wanted to talk about. And that's why we always love talking about good deals for good people. And this is a great story of business, kind of out of the way here in Florida, up in Tallahassee. But we have longtime broker Anthony Geronimo with us. And Anthony, why don't you quickly introduce yourself?
Well, thanks, Andy. This is Anthony Geronimo. I've been in the business for about 15 years. I'm a certified business intermediary through the IBBA, also a certified M&A professional. Really love doing this business. And one of the things that I do find the most rewarding is that when you put the right people together for the right transaction, it really is a win-win and you feel really good about it. So
why don't you give us a little bit of an outline of who the buyer was?
The buyer was, he became really the perfect fit. He had an extensive hospitality background, so he really understood how to manage people, and he was tired of kind of running around the state of Florida and different areas. He really wanted to establish some roots, so when he came across this opportunity, it seemed like a really good fit. And, the reason it was such a good fit is because this dry cleaner in particular did so much volume every year. They had really a small army of staff working in the back there. I mean, really at any given time, there was, 10 to 15 people working in the facility. So he just was a really good fit in that he knew how to manage people and psychology of working with a lot of different folks from a lot of different walks of life.
How did we structure the deal? Or, what was the price, eventual price it sold for, and how did we structure the financing?
The pricing was really strong. The business ended up selling with the property for $1,950,000. $800,000 of it was the property side. But this gentleman really used all of the resources that we, as experienced intermediaries, recommended to him. He ended up doing a 401k business rollover program, and then he ended up using one of our premier lending relationships to do an SBA loan. So that was really strong. He took those 401k funds, used it as the cash down payment for the loan. And we were able to do this, Andy, in literally a very, very short amount of time. From the time we had the offer to the time we closed, it was 31 business days.
So, I mean, it just goes to show you the strength of the Transworld network. That this buyer would have never thought of going to Tallahassee. And this Tallahassee, very established dry cleaner, probably wouldn't have found a perfect buyer like this. And using all of our tools in our basket, like Stearns Bank, and I think we use Benetrends as the rollover company, this person was able to leverage into the deal, establish a great place for him and his family to live. And we have two happy sides, right?
Absolutely. The sellers in particular were looking, they really put blood, sweat, and tears into this, worked at 6-7 days a week for many, many years. And they have grandchildren, and they're ready to just retire and slow down and enjoy life a little bit more for themselves. So, here they were, they got to ride off into the sunset, and they really did a phenomenal job of transitioning with the buyer, spending extra time. They said, even if something happens 6 months, year down the road, you need to change a filter, get a machine repaired, you call us, we're down the road, and we'll be here to help you.
Great job, Anthony. Good deals for good people. Thanks, everybody. So let's talk about quality of earnings. So quality of earnings to me is like first of all, you're able to find the earnings, right?
And you've got great books and records, and and we're going to talk about that a lot more later, I think, in future podcasts, but that's a big driver of quality.
Right. And so, and customer concentration issues could be coming. So good, diverse customer base, location. We have a whole location podcast, but if you have a good location, the brand, what are some of the other things?
Yeah, I mean, employees, especially in a market with low unemployment like we're having right now, employees and a good management in place can drive quality, goodwill or market share, things like that in a market. There's also ultimately, and we should talk about this more, but the value of the assets are included in the transfer too. How much are those assets worth? Are the assets in good working condition? Do they increase the profitability of the business? And then I think, one of the big things we talk about is the ease of transfer too. How easy can this business be transitioned? Because ultimately that reduces the risk too if it's an easy transfer.
Yeah, right. And so, and listen, back to valuation a little bit. The earnings method is based on future earnings, and really, what the buyer is buying is future earnings. So it's very, very important that whatever we're showing people as a seller's discretionary earnings, it's going to happen again. That's the simple man's way of predicting the future, is just looking to the past. So the past year financials are going to be extremely important, plus the trend, right? A business that's flat, is flat.
Yeah, or down. I mean, that's inherently risky too, as if your earnings or your revenues going down over a time period.
So, and the funny thing we always say, and this is true, business valuation is an art, not a science, right? So there's no two business valuation experts would agree. You could see this in family court every day. A divorce. Somebody gets a business valuation and says the business is worth $2 million. Some businesses, the next person, same business, gets a valuation, says it's worth $200,000, and they both have these huge, thick valuations that show that they're right. And so, but what we try to do here at Transworld and really across the industry is get consistent, right? So, now that things are on the internet, you can compare deals, and you could compare investments. And so all of these and on the website, you're looking at the DE. And by the way, SDE, seller's discretionary earnings, same thing as adjusted net, is the same thing as DE, is the same thing as seller's discretionary cash flow. So it's called all these different things. We're all trying to get to the same number. And really looking at business 2 to 3 times, and perhaps you're going to see businesses that are, selling for a little bit more. They're trying to go out to the marketplace and expecting a negotiation. We'll talk about negotiations and making offers in other podcasts. But today we want to get you comfortable with value, right?
Right. And, I think ultimately why we don't see more deals done is because both sellers and buyers don't adequately understand how businesses are valued. And, I think when a buyer, especially a savvy buyer, is searching the internet for these deals, they're searching based on some of these metrics that they understand. So if they see a business that's priced outside of the scope of expected value, they're not going to inquire research on that business, because ultimately they're looking on it for an adequate return on investment. And they're comparing things on the market to each other as well. So I think this is a really important topic for our listeners to understand. Is a complex topic, and honestly, I don't think there's a lot of great information out there, and there's a lot of confusing information because, like we talked about, there's multiple different methods on how to price a business and why you would price it a certain way. But the buyers and the sellers that do understand this topic are more successful in the marketplace.
Yeah, I agree with you. This is the number one killer of all deals. I mean, if the business marketplace is super inefficient, which it is. I mean, people are trying to sell their businesses historically. Something like, I've heard all kinds of crazy statistics. 1 in 5 businesses sell, and it takes 20 buyers to look at a business to buy. Well, the only reason is the buyer doesn't think it's worth the money, and the seller doesn't feel like he's getting enough money. And if we could educate everybody, that's why we want everybody to be super educated. That's why we started this podcast. We want people to understand. And I always tell people, listen, you're going out to buy a business. It's like buying a house, right? You're not going to buy the first one you look at. You're going to want to look at the neighborhood. You're going to look at a bunch of different houses. You're going to compare the attributes of each. And then you're going to finally feel comfortable with prices out there. And once you and same thing in business. So once you get comfortable looking at deals, looking at different business opportunities and understanding value, then only then are you going to buy. So this is a very important topic that we wanted to cover today. Hey, Jessica, you know what time it is?
Money time?
Almost. It's time for listing of the week.
All right, so today for our listing of the week, we have Chris Cantwell from our Denver office. Chris, say hi and tell us a little bit about your listing of the week.
Thanks, Jessica. Yeah, my name is Chris Cantwell, and I'm a broker with Transworld Business Advisors Rocky Mountain. And I do a lot of work up in the resort mountain communities. I've got a great restaurant bar that's listed in one of those communities now. It's just steps away from the chairlifts. It's got great foot traffic. They actually own the real estate. We consider selling the real estate as well. They're going to do about $1.3 million in revenue this year, with the SDE cash flow coming in, should be right around $300,000, maybe a little bit north of that. They're asking $799 for the business. If you'd like to learn more about this resort town restaurant bar, feel free to give me a call, 303-408-3882, or email me at Chris, CHRIS, at tworlddenver.com.
Great. Sounds like an awesome opportunity. Live in a ski resort and own a bar restaurant. So if you need more information about this business, reach out to Chris and we'll drop all that information down to the show notes. Thanks and happy hunting. Yeah, so let's maybe recap for the listeners too, the main points of valuation that are important when you're shopping or selling a small business, which in our scope means $1 million or less in EBITDA. But it's going to be based on the market valuation method, which is using comparable data and coming up with an adequate multiple of earnings called SDE. What are some of the other important high-level things to remember, Andy?
Well, it's 2 times. I mean, you could really kill the idea. Like, listen, if your business is hot and it's a great business and is earning $300,000, $400,000, $500,000 and the trend is up, yeah, it's going to have an upward pressure on the multiple. So maybe we're sneaking up to 3. We just looked at a 40-year-old business. It has been in business for a very long time. It has perfect books and records. It owns the properties, which are highly leverageable, and the business is leverageable. And we didn't even talk about that. But if businesses can get bank financing, they're going to sell for more. So maybe that's a 3, maybe that's a 4-time multiple on $500,000. But back down if you're selling a run-of-the-mill restaurant or another hair salon, or sometimes a service business that take a lot of work, it's going to be 2 times at best.
Yeah, at best. Like you said, there's those outliers, but those are fewer than typical, and that's going to be based on that quality and quantity conversation that we had. And ultimately, if the business is going to sell for more, you also have to create competition in the marketplace, right? So businesses that do sell for 3 or 4 times are businesses that typically get multiple offers, have multiple buyers interested, and that creates that upward pressure of increased prices.
Yeah, there's a lot of things that create upward pressure, and obviously getting with a good broker. And, of course, we'll always promote Transworld Business Advisors, because of our large network, and we have lots of brokers and we have lots of buyers in our database, and we're creating competition for the deal. Which is really important. But, again, sometimes, business owners are like, well, if it's only worth 2 or 3 times, I'll just keep my business. And you know what my answer is? Yeah. Keep your business. And, keep it for 2 or 3 years. And then they always come out with the real reason. Well, I'm sick and tired, or I'm, legitimately sick, or I'm getting a divorce, or I'm moving out, or the business is growing so fast, I really don't want to deal with it. My employees are driving me nuts. You're really going to have another reason for selling your business just to cash in, right?
Yeah. I mean, like I always say, yes, there is a financial decision to sell your business, but ultimately it's an emotional or personal decision. That's what's really driving the reason to sell a business or even to buy a business, right? There's some other thing that's pushing you, like you said, relocation, retirement, just being plain done and wanting to do something else. But that's the real reason driving you to sell, not the financial one always.
Yeah. So, and then the last thing I kind of want to tag on to this as well is, listen, it is all about earnings. And, there are two things. Number one, there are outliers, right? There's always the business that we're super surprised that sold for lots more money than we thought it would, because, we found the perfect buyer, which happens. I mean, those are strategic buyers, and those are, you know, different kind of situations where we could find, like, we had a plastics company that really wasn't making a lot of money, and we found another plastics company that needed that location, that wanted that location, that was willing to pay more. And we've seen that before, right?
Yeah, yeah, we've seen that in a lot of different industries and things like that. And I think there's also, outliers on the other side too. Like what we haven't talked a lot about is businesses that don't make money, and sometimes we can sell those for just a percentage of the asset value too.
Yeah, that's a great point. Back to the valuation methodologies. There's the asset method, the market method, and the comparable method. And those two last ones, the market method and comparable method, which is the same thing, and the income method, excuse me. Those rely on income. The asset method is the only one that deals with assets, perhaps for a business that's not making money. So we have lots of businesses that are just done, right? Like restaurants that have a super build out, hair salons that have a super build out, manufacturers that no longer manufacturing the right, quote unquote, a product that could sell anymore. So we are able to sell those asset sales for not exactly for asset value or what they put into it, but sometimes a percentage, right?
Yeah, I mean, and I think we have one of these on another episode coming up. But we had a gym that was losing 200 grand a year, but it was a large gym, and there was a $500,000 in just equipment in there. So we were able to sell that for a couple 100,000, and that's what I think you see. You see a percentage, depending, negotiable, obviously, of what the assets are worth.
Yeah, and listen, this is all opportunity for buyers. I think buying a business is probably one of the safer investments out there in the world. You think about stocks, you think about bonds, you think about real estate, you think about speculation in the marketplace and startups. We're talking about buying a business where you're going to make your money back maybe in 2-3 years. You can see the trends of the businesses. These, we always say, are there more bad owners or are there more bad businesses? And for the most part, there's bad owners. So buyers can take advantage of this. And if you're going to start a business from scratch, you have a new restaurant concept. You want to build out a spa or a medical spa or a medical office. Oftentimes we have people that spent incredible amounts of money and just can't operate the business. They're not good at it. So that's an opportunity for the buyers, right?
Yeah, I mean, it's an incredible opportunity. Like you said, I agree too. I think it's one of the safer investments. I think it's a less expensive way to start a business too, is to acquire one that either has done all the heavy lifting already for you or it is already making money. But I think we've covered a lot in this podcast, and we will put in the show notes too. We have a great resource on our website. If you go to tworld.com under sell a business, what my business is worth, we'll put that link in the show notes too, because it kind of outlines everything we've talked about in a very easy to read and digestible kind of article too. So we can reference that for the listeners.
Yeah. And if you're a buyer out there, this is your number one job. You need to get to know the marketplace. Look at the listings on the web, and just don't look at the listing of the web. Go visit them and understand how the SDE was calculated and understand what they're asking for the businesses. And then only then are you going to be an informed buyer. And we have people that have bought businesses over and over and over again from us, and it's almost like they have a secret sauce. They understand that they're getting these great deals out there just because they know the marketplace a little bit better and understand valuation. So this is a really important topic.
So again, this is a really, really heavy topic, but like Andy said, really important topic. And that's why we spent an entire podcast just talking about it and not doing interviews like we typically do. But really educate yourself, ask questions of us, reach out if you have questions, ask questions of the brokers that you're working with, really understand their valuation methods for each and every business you're looking for. And again, we'll put the link to our website in the show notes for some of those articles that we referenced. But Like Andy said, this is your number one job. Go out, educate yourself so you can understand what your business is going to sell for, or ultimately, if you're looking to buy, what you're able to pay for a business.
Yeah, and just keep it simple. Just keep it simple. And I think
2 times.
Right. 2 times. That's it. Thanks for tuning into our show today. If you like the podcast, don't forget to subscribe through your favorite podcasting app and leave us a review. If you have questions or suggestions for the show, visit us at tworld/thedealboard or email us at thedealboard@tworld.com.